Okay, guys, so I'm just going to be honest with you. We have a massive problem on our hands. The bond market is what I would call coming unhinged. Now, what unhinged means is there's no real rhyme or reason why this is happening from what we can tell. It's kind of like a short squeeze. Call it meme stocks that just rise to rise because everyone's buying them. And of course, there's no justifiable reason that that's happening. People are just buying it. Well, in the bond market, see, bond yields actually stay the same. What you get paid on a bond does not ever fluctuate. The price of the bond fluctuates. So you're seeing here on screen TLT. TLT is the ETF for the 20-year treasury. It kind of mimics most of the curve of TLT or of treasuries. Without getting too complicated, not to confuse people, but 10-year, 20-year treasuries, they kind of revolve around the same ideology. Long-term inflation expectations, economic growth expectations. So they tend to roughly do similar things. This line here, this horizontal line or vertical line that I have here on the chart is the exact moment of the last Fed press conference. This was on September 18th. And bonds have been selling off ever since. You actually hit the high on September 17th, early in the trading day, and then you sold off, and then you sold off every day since then, pretty much. There's been a couple up days on TLT, but not many. Now, what's really fascinating is right at about October 16th. This was, if you include October 16th, 1, 2, 3, 4 trading days since October 16th. But pretty much right at the moment that Trump's odds of winning went above 60%, treasury yields have been plummeting ever since. Or yields have been rising, bond prices have been plummeting. Again, I don't want to make this too confusing. It works like a dividend stock. If you buy a $100 dividend stock that pays you $5 and that yield never changes, that is a 5% yielding dividend stock. If that $100 stock falls to $50 and it still pays you $5, then that's a 10% yielding dividend stock if you buy it. Vice versa, if the stock doubles up and goes to 200, then it's going to yield you 2.5%. Hopefully that makes some sense. But ever since Trump got above 60% odds, which was around October 16th, October 17th, Trump actually hit 61% odds of winning the election. As per Poly Market here, there's other things you can look at that are going to fall in the same similar dates. Treasury yields have been skyrocketing. And today was really alarming because it was a massive sell-off for the wrong reason. See, as I explained just a minute or two ago, 10, 20-year treasuries, their yields don't really fluctuate based on what the Fed is doing today. Okay, that's like the 3-month to even 5-year treasury. Even though 5-year does start to have some longer term implications, the short duration yields revolve a lot around what the Fed is going to be doing. 10, 20-year treasuries revolve around inflation expectations and economic expectations. So ever since this Trump presidency has started getting priced into the markets, you've heard this phrase, the Trump trade. Bond yields have been skyrocketing. Basically, the market's saying inflation is going to be higher, government spending is going to be higher, and the economy is going to be better. Now, you can make an argument on the whole economy thing. Some people are saying it'd be better, some people are saying it would be worse, but that's just what the yields imply, that the Fed will not be able to cut rates as much, and potentially the neutral rate is even rising, like literally rising as we speak. The problem with this is once you get to a certain point, you start to put a lot of pressure on equities. And it may not have felt like there was a lot of pressure on markets today if you are in something like Nvidia that hit a new all-time high today. Nvidia basically went straight up throughout the day today, up over 4%. In after hours, stocks up even more than that, soaring to a new all-time high. Apple was up almost 1% today, and up again even here in after hours. Some other big tech names like Google were positive today. Meta, Amazon, Microsoft, down 0.5% or so. Not really a big deal. But if you look at the equal weight S&P, that thing was down almost 1% today. If you look at something like Tesla, interest rate sensitive company, was down 1.26% today. The average stock did not have a good day. So here's the kicker. At a certain point, if 10-year treasury yields continue to be unhinged, just, prices falling to fall because everyone's shorting bonds, more people start shorting bonds, and more people start shorting bonds, and more people start selling, then you start to run into a problem even for those big tech names. You also start to put a lot of pressure on banks because banks have a lot of unrealized losses, and their unrealized losses in their bond portfolio is represented by the price. So TLT, for an example, is at $92. If, let's say, it does start to creep back towards 5%, TLT is going to be roughly in the $79, $80 range. That's going to put a lot more pressure on the banking system that's already in a fragile position. Now, you might not think so, but the FDIC just listed 66 more banks that are in danger of becoming insolvent, the highest we have seen since the banking crisis, since pretty much 2009. And you can think about this much the same way as a short squeeze in a meme stock and a company that's going bankrupt. There's been a couple companies over the past 12, 24 months that have went bankrupt, and their stocks have went up hundreds of percents in the course of just a couple of days. There's obviously no reason for that. If you were trading that stock, you knew ultimately it was going to zero. It was going to be delisted. It was going to be non-existent. But people still bought it. Wall Street still bought those. Okay, they still traded those. That's what's going on in bonds right now. Everyone's just jumping into the trade because the next guy's in the trade. That's really what I mean by bond yields could start to become unhinged. I talked about this in the last video, but the Conference Board leading economic index came in well worse than expectations today. We were expecting negative 0.3% as the estimate. We came in at negative 0.5%. So meaning companies are not feeling that confident about the economy, and things are probably getting worse out there as we speak. And that's the big problem. We also had some Fed speakers today that sounded still kind of concerned about the labor market, still saying that they expect to moderately reduce rates, that there is a risk of further, weakening in the labor market. Well, there's also a risk that inflation could be stubborn. It was kind of a mixed view. So Fed speakers were not super, bullish or super hawkish for that matter. But the economic data came in worse than expected. Now, throughout this period, since September 18th, I really haven't been worried about the bond sell-off we had seen. Of course, I've been watching it. Everyone else has been watching this as well, because it's one of those things, a little bit of selling, not a problem. Yields probably should go higher if the economic data comes in good, and maybe the Fed was too aggressive in their summary of economic projections, right? There's so many different things you can say to justify bond yields rising a little bit from their rally that they had seen. They were pretty overextended to the upside anyways. But bonds were rallying for the right reasons. Bonds were rallying because the economic data continued to come in good, or at least the government numbers on face value did. The jobs report numbers were revised up. We had a big gain last month, right? Retail sales came in really strong, and pretty much every other data point you've gotten since then has been strong. So that makes sense why bond yields would drop or rise and bond prices would drop. But today, the fact that 10-year treasury yields skyrocketed on bad economic data proves that the bond market is now unhinged. And when the bond market becomes unhinged, that's a problem. 10-year Treasury yields closed out the trading day at 4.196%, almost 4.2%, up 12 basis points today. This is similar to like a jobs report that comes in at like 400,000 jobs. Like that's the kind of tightening that we are seeing today. But in fact, you got bad economic data. So I hope you guys understand just how crazy this is that 10-year Treasury yields are doing this. But again, back to the point, when 10-year Treasury yields become unhinged, they can be unhinged for a while. Rallies in bonds tend to last months, not days, not weeks, but months. And when everyone is piling into the same trade, piling into the, short bonds, sell bonds trade, then when does that stop? I mean, with the government spending levels the way they are, 7% deficits, you could justify a 10-year Treasury yield being potentially at 5%. And the bigger problem is if 10-year Treasury yields, let's say, do go up tomorrow another 5 basis points to 4.25%, that will start to have a larger effect on equities. And it could be quite aggressive, meaning the higher bond yields go, the more pressure you're going to start seeing on stocks. Now, if we become really unhinged, then you can make your way to 4.5% or 5% on the 10-year Treasury. And at that point, I don't think markets are going to be in a great place at all. Now, we are going to take a listen to this clip from CNBC together. It says, Fed mismanaged rate cuts and long-term rates could continue to rise. But look at some of these clips from CNBC today. They're absolutely outrageous. They're egregious. This clip says, buy high and sell higher, says Solus Dan Greenhaus. This one says, today's market action, relatively normal profit taking. Let me just tell you right now, nothing about what you've seen today was normal. And if this continues into tomorrow, trust me when I say we are going to have a big problem.
Guests say that short-term rates are down now with Fed easing, but that long-term rates may continue to go up. For those who think inflation could be a little bit sticky. For more on how to position against that, let's bring in Kamal Srikumar. He's president of Srikumar Global Strategies. And Max Wasserman is senior portfolio manager at Miramar Capital. Sri, you've been warning about this for months now. Why is this taking place? And what does it mean?
The Fed mismanaged the interest rate cut on September 18th, Kelly. You have heard me say that before. My suggestion then was there'd be no rate cut at all in September. Instead, there was a jumbo rate cut. So the Fed believes that when they cut the short-term rates, the long-term yields will also come down. But the basic truth in economic theory is that the Fed controls only the short-term rate and the long-term rate is determined by the market, number one. Second, if you are in equities and inflation picks up again, you have protection in the form of your equity price going up and giving you some form of a safe haven. But if you are in bonds, you do not have a safe haven because when inflation goes up, the interest rate doesn't increase on the bond you're holding. So bonds are much more sensitive to inflation and they are reacting to higher inflation expectations. One other warning. Neither presidential candidate is talking about how to cut the fiscal deficit, how they are going to deal with the debt in the new year after January 20th. And unless the new president does something about it very quickly, I am looking for the 10-year to head toward 5%. So in other words, the increase that you have had so far is not sufficient. More Fed mismanagement in the form of more rate cuts in November and December, as Steve referred to, will only hasten the increase in long-term yields, Kelly.
Okay. I'm looking, you mentioned that inflation, and yes, politics may be a big part of that. We'll have more on that in a bit. But the inflation expectations are up if we show the 5-year break-evens. That's the near term, not the forwards. They were at, and Steve, I'd like you to weigh in on this. We were at under 2. Now we're at 2.25. That's a decent move in the past couple of weeks.
I think it is for sure. I just not sure that further Fed rate cuts will bring down, will cause yields to rise. I really think it's the inflation outlook and the outlook from Fed officials that will ultimately tell us where we're going to go. The market also has a belief, Kelly, that growth is inflationary. I don't believe that to be the case. I think what we've seen strong growth and strong job growth without the inflation. So we'll see. I think that stubborn inflation report was part of the problem. I think also a bit of a hangover among Fed officials having done the 50 that they may want to pause so the market's a little more circumspect about the outlook for rates.
Shri, normally we debate the theory of this, but can you be very pragmatic about this for a moment? I mean, we've heard high-profile folks like Druckenmiller say they're shorting bonds. Today, Joe Livornia was saying maybe the 2 years is going to sell off quite a bit more and go up. I mean, what is the practical advice for investors, even if it just relates to, look, the stock market, other than the Russells and maybe other than, it's largely taken this in stride and shrugging it off?
The way you're going to react to it is, first, if you are, to the extent you are in fixed income, you want to reduce the duration of the holdings. Rather than hold 10-year, 30-year paper or long-term corporate paper, come shorter term. They are going to lose less money when the yields go up. That is one thing you would do. Second, find yourself some alternatives to bonds and the current setup. In addition to equities, you are looking at gold. And I've been looking for gold as the ultimate currency, Kelly. And you referred to it earlier on in the program, that even though the dollar has strengthened against the euro, think about the gold price as if gold is a currency and dollar exchange rate is given by the gold price. And that is shooting up, which is essentially telling you that there is a flight from currency. The market is leaving the dollar, it is leaving the euro and seeking gold as a safe haven. It's going to be more of it. We are now at about 27.30, 27.50. I would see it hitting 3,000 before year end. And more policy mismanagement, we'll be looking for even higher yields.
Now, this whole situation is a bit more of a bummer if you are invested in Tesla, because Tesla, while it is such a great company, I mean, what a fantastic company Tesla is with great long-term growth prospects. I can't think of any other $700 billion company that has the kind of long-term growth prospects that Tesla has. You can make an argument for like a Novo Nordisk or something with the GLP-1 drugs, just because so many people are, overweight or in need of those. But besides that, there's really nothing that stands a torch to Tesla. There's so many great things we can sit here and say, and Tesla has earnings coming this Wednesday, but Tesla will be affected by the rise in long-term yields, because especially what Tesla's strategy in recent months has been is buy down the rate, give consumers a 0% or 2% rate on cars. Okay, the average car loan, anywhere from 5 to 7 years. So those yields are dictated around 10-year treasury yields, right? That's the benchmark. Like, for an example, I wouldn't give you, let's do it this way. I wouldn't give you a 10-year or 7-year car loan at a 5% interest rate if I can get, 4.2% in a 10-year treasury risk-free. You are more risky than the government, and yeah, the higher the government yields go, the more I'm going to charge you. Then maybe I charge you 7% or 8%, or if you're a riskier borrower, charge you 10% or more. Okay, so Tesla has to buy that down. So every day the yields go up. Like today, right? Tesla, for the Tesla sold today, call it 2, 3, 4,000, 5,000, whatever the number is, globally, well, Tesla had to spend more money today than they did yesterday to buy down the same amount of cars for customers, buy down the interest rate. That's a problem when you're thinking about Tesla's profitability. Wall Street's expecting about 30% EPS growth for Tesla over the next 4 years. But that is also assuming that yields are going to come down, that yields are not going to go to 5% and stay there for a while. That's not factored in at this point. As that starts to become the conversation, that's going to put more downside pressure on Tesla. Now, Tesla stock today really felt that pressure, was down 1.26%. Here in after hours, down almost 1/10% yet again, as you can see 10-year treasury yields continuing to rise here in after hours. TLT down 0.04% here as we record this video in after hours. Tesla stock closed below its 100-day moving average for the first time in 7 trading days. The prior 6 trading days, Tesla stock held support at this 100-day moving average, and you did not today. You closed below that. Although there was a lot of demand around this 100-day moving average, you technically did close below that. And at the time of recording this video, Tesla is $218.61. That 100-day moving average is $219.15 per share. Now, I think heading into Wednesday, what treasury yields do is really going to dictate how Tesla trades. At this point, after a rise like this in 10-year treasury yields, they're probably going to continue to go higher. I think there's very low odds at this point that yields come down in any kind of meaningful way between now and Wednesday. So that's going to put more downside pressure on Tesla. And then what Tesla has to say about buying down these rates, how that's affecting profitability, will really guide Tesla next. Because let's face it, the rise in 10-year treasury yields started around September 16th. The end of the quarter was October 1st. So Tesla benefited from a fall in 10-year treasury yields all of last quarter. If Tesla's margins do not come in good for last quarter earnings, what do you think Wall Street's going to think about this quarter, where yields have been rising the entirety of the start of this quarter, which again started on October 1st? If markets start to say 10-year treasury yields are going to go into 5% or 4.5%, and last month's margins were not good, we're going to have a bigger problem. Now, I think the ultimate deciding factor, whether or not Tesla is going to respond well, move higher after Tesla earnings, will come down to whether or not we still get confirmation of the lower price Tesla coming by midpoint of next year. If that's delayed at all, Tesla's obviously not going to have a good day. If Tesla reaffirms that guidance, then Tesla should do well following earnings as long as the margin story was good last quarter. But it's going to make it way trickier to trade Tesla. So if you're trading Tesla, if you're not buying and holding for the long term right now, you ought to be a little bit concerned with what we're seeing in the treasury markets. Now, does this matter long term? Absolutely not. Joe Schmo, treasury that, treasury this. If Trump wins, as what the betting markets are implying, inflation's going to fall. The Fed's going to cut rates more than expected. I think we understand these things. I think we're smart enough to understand that. But between now and at least the election, and maybe the couple of weeks after the election, there's going to be a lot of questions about just that. Where's neutral? How high are treasury yields going to go? And right now, the yields are unhinged. They're not following a logic. There's no rhyme or reason to why this is happening the way it's happening. And I think that is a problem, again, in the near term for the markets, and specifically a problem in the near term for Tesla stock. So unfortunately, I wish I had some good news on that front. I do have some good news as far as option activity in Tesla today, if I can be allowed to give you some good news. We had 66 different trades from big money today, totaling $31.47 million, with a positive order value of 71%. So even though Tesla stock was down today, it does look like that was an opportunity from hedge funds and institutions to, get some bullish exposure in Tesla, which makes sense considering Tesla's down quite a bit from the robotaxi event heading into Tesla earnings. You can also see there was not a whole lot of shorting activity in Tesla today. Only about 67,000 shares on net were sold short today. So it's not like people, or really Wall Street, got super bearish on Tesla today, even though a lot of the markets were down and yields are doing what they're doing, people are still not getting that bearish on Tesla. Right before Tesla earnings, I would say that's a good sign. It will also be fascinating to see what happens with Nvidia, just how high this thing can rally and try to hold markets afloat, because without Nvidia today, markets would have been deep in the red. We were red today on the S&P, but that was because everything else sold off. If Nvidia did not rise 4% today, it would have been a really bad day. Now, how long can Nvidia just continue to go straight up and have these 4% days? I do not know. So if tomorrow treasuries sell off like they did today and yields rocket again, is Nvidia going to have another 4% day? It could start to become hard to manage. And if Nvidia does not save the markets in the coming days, it will get very red quickly. So maybe the election correction could come. We'll see. Let me know what you think about all of this information down below in the comment section. Hit the like button as well as subscribe to the channel if you have not done so already. You guys have a safe rest of your day, and I will see you in the next one.